Hi, I'm Sharon Pinto from Manoj Kothari and Company. In this video, we'll be doing a regulatory roundup relating to corporate debt. The year 2023 was quite significant with respect to corporate debt because of the numerous amount of amendments that came in during the year. So in this video, we'll try to glance through all the significant amendments and the link to this presentation as well as detailed articles relating to each of the topics that we're going to discuss have been provided in the description box. So those can be referred to for further reading. Okay. So in this video, we'll be discussing on the amendments in two parts. Firstly, under SEBI ILNCS, that is Issue and Listing of Non-Convertible Securities Regulations 2021, and the Master Circular thereunder, and the SEBI Listing Regulations 2015, and the Master Circular framed thereunder. Now, in case of amendments that came in pursuant to the budget 23-24 and which had an impact on corporate bonds, we have detailed articles on the same. The space where these articles are available, the link to the space has been provided in the presentation. Let us start with the SEBI ILNCS related amendments. So the SEBI introduced the large corporate borrower framework in wide circular dated November 26, 2018. And this framework was applicable on a comply or explain basis for the first two financial years, that is FY 20 and 21. And thereafter, it was applicable on a comply or pay penalty basis from FY 22 onwards. Initially, it was applicable for a block of 2 years. That is, it was to be complied over a block of 2 years, and this was later extended to a block of 3 years. Now, SEBI White Circular dated October 19, 2023 has brought in certain changes in this framework, and this revised framework would be applicable from FY 25 onwards. Let us briefly see what were the requirements under the erstwhile large corporate borrower framework. So, certain entities which have been identified as large corporates were required to raise at least 25% of their incremental borrowings by way of issuance of debt securities. Now, who is a large corporate borrower? So, entities which satisfy all three criteria. That is, they have their listed specified or debt securities or NCRPS. They have outstanding long-term borrowings of 100 crore or more, and they have a credit rating of AA and above, would be referred to as large corporates. And these entities would have to comply with the requirement under this framework. What is incremental borrowings? Incremental borrowings are long-term borrowings having original maturity of more than 1 year during a particular financial year. And there were certain exclusions from the definition of incremental borrowings. That is, ECBs and intercorporate borrowings between parent and subsidiary entities were excluded from the meaning of incremental borrowings. What was the consequence of not complying with this requirement? So under the framework, if an entity was not able to raise the requisite amount of borrowings in the form of issuance of debt securities over the block of 2 years, they were liable to pay a penalty in case of such shortfall. Let us look at the changes that have been brought in under this framework. So the major changes include increase in the threshold of long-term borrowings, that is the criteria for being identified as a large corporate borrower. This threshold has been increased from 100 crores to 1000 crores. Secondly, the meaning of incremental borrowings. So the term incremental borrowings has been revised to qualified borrowings. So the nomenclature has been revised to qualified borrowings. Secondly, certain additional exclusions are now have now been introduced. So the meaning intercorporate borrowings between the parent and subsidiary as well as with associate companies has been excluded. Further, funding from government borrowings on account of interest capitalization has also been excluded from the meaning of incremental borrowings. Thirdly, the requirement for having a credit rating of AA and above, which was proposed to be excluded from the eligibility criteria, has been retained. And lastly, the block of 2 years has been extended to a block of 3 years, over which this requirement is to be complied. Lastly, the penalty provision has been done away with. In place of the penalty provision, an incentive and disincentive scheme has been introduced. So, in case a large corporate has any surplus borrowings at the end of 3 years, that is, at the end of the year of FYT plus 2, it would have benefit in two forms. Firstly, reduction in annual listing fees of the financial year T plus 2, and secondly, credit in the form of reduced contribution to the core settlement guarantee fund. Now, what is a core settlement guarantee fund? We'll be deliberating on that in the further slides. On the other hand, if there's a shortfall in the borrowings, in place of the penalty, the large corporate would have to make additional contribution to the core SGF. Let us try to understand the incentive disincentive scheme by way of an example. So, in case an LC was required to raise an amount of 250 crores over the period of over the block of 3 years, that is FY 25, 26, and 27, considering FY 25 as the year T. And if at the end of the year T plus 2, that is at the end of FY 27, it has raised an amount of 300 crores, then there's a surplus of 50 crores, which amounts to 20% surplus. Now, if you look at the table alongside, in case of the first benefit, as per the slab, it would be eligible for a 4% reduction in the annual listing fees. Now, coming to the second benefit, since there is a surplus of 20%, again, it would fall under the second slab, and a reduction of 0.02% would be available in the contribution that it is required to make to the core SGF. So in this example, it is required to make a contribution of 1 crore. Accordingly, this amount would be reduced by 0.02% of the surplus. That is 0.01 crores. And it would have to make a contribution of 99 lakhs in place of 1 crore. Let us look at an example relating to the disincentive scheme. So, for example, an LC was required to raise 800 crores by way of issuance of debt securities, and it has raised 500 crores. So there's a shortfall of 300 crores, which amounts to 37.5%. So if we look at the table alongside, this falls under the third slab. So accordingly, 0.035% of additional contribution will be required to be made to the core SGF. So it had an existing obligation of 5 crore, as we can see in the example. So 5 crore plus 0.035% of the shortfall, that is 0.105 crores. And so in aggregate, it would have to contribute 5.105 crores to the core SGF. Now, under the revised framework, there have been certain responsibilities that have been placed on the large corporate and the stock exchanges. Large corporate, as we have already discussed, they are required to raise at least 25% of their qualified borrowings during the financial year by way of issuance of debt securities over a block of 3 years. In case of stock exchanges, firstly, they are required to release a list of large corporate entities based on the financial results of the quarter ended June 30 for large corporates following the financial year April to March, and March 31st for large corporates following the financial year Jan to December. And this list is to be placed on the website of the stock exchanges. Secondly, stock exchanges will be required to calculate the incentive disincentive, again based on the financial results, and this they would have to intimate to the large corporates. Thirdly, they would have to share relevant information regarding the incentive disincentive with the LPCCs. Now, what is an LPCC? We'll be discussing that in the further slides. Next, let's see the changes with respect to offer document. So, under the erstwhile requirement, in case of a public issue and a private placement, there was different sets of disclosures that were required to be given in the offer document by way of two different schedules, Schedule 1 and Schedule 2 of the NCS regulations. Pursuant to the amendment, both of these schedules have been combined, and at present, a single Schedule 1 has been prescribed for disclosures relating to private placement as well as public issue. The intent behind this was that a privately placed instrument, once it gets listed, becomes akin to an instrument which was issued by way of public issue. So, in order to bring parity between the disclosure requirements, there have been changes and common disclosure requirements have been prescribed. Next, the SEBI has also mandated disclosure of issue-related expenses for issuers of NCS. There have been certain heads that have been identified, like lead manager fees, brokerage selling commission, fees paid to the registrars to the issue, fees paid to the legal advisors, advertising and marketing expenses, etc. These would have to be mandatorily disclosed. SEBI also introduced the concept of a general information document and a key information document, that is a JID and a KID. Now, disclosure in this manner is applicable on a comply or explain basis till 31st March 2024. And in case of issuances post 31st March 2024, issuers would be mandatorily required to disclose offer related information in this as per this framework. So, what is a JID? A JID would contain general information regarding the issuer, its promoters, directors, financial information, etc. This document would have a validity of 1 year from the time of first issuance under this document. Now, if we look at KID, a KID is issue specific document. So it would have information relating to the specific issue, and this document would be required to be filed every time at the time of each issuance. The concept of a shelf placement memorandum has been done away with, and in place of this, a KID has been introduced. Next, we look at the amendment relating to appointment of nominee director by DTs. So DTs have a power to appoint a nominee director in 3 events as per Regulation 15(1)(e) of the DT Regulations 1993. These events include 2 consecutive defaults and payment of interest to the debenture holders, or default and creation of security for the debentures, and thirdly, default and redemption of debentures. Pursuant to this amendment, which is effective from Feb 2nd, 2023, issuers were required to amend their articles to provide for an enabling clause, and the timeline for the same was till September 30, 2023. In case of first-time issuers, they have been provided a period of 6 months to comply with this requirement, and they would be required to provide an undertaking to this effect at the time of obtaining in-principle approval. Once a nomination has been obtained by the DT, issuers are required to appoint the nominee director within a period of 30 days from the receipt of this nomination. Similar changes were also required to be made in the DTD, and the timeline for the same was also till September 30, 2023. Next, we look at the amendment relating to legal entity identifier. So, an LEI is a unique 20-digit code used to identify legal entities which engage in financial transactions. This is to bring in more transparency in the framework of financial transactions. So, before the amendment, RBI mandated all non-individual borrowers availing an aggregate exposure of 5 crore or more from banks and financial institutions to obtain an LEI in a prescribed manner over a phased period. But SEBI wide circular dated May 3rd, 2023 has brought in this requirement for issuers of NCS and SDIs and SRs. So in case of issuers having outstanding listed non-convertible securities as on August 31st, 2023, they would have to obtain an LEI on or before September 1st, 2023 and report it in the centralized database for corporate bonds. In case of issuers who propose to issue and list NCS on or after September 1st, 2023, are required to obtain it before the allotment of ISIN. Similarly, in case of securitized debt instruments and securitized receipts, that is SDIs and SRs, issuers having these outstanding securities as on August 31st, 2023, were required to obtain the LEI on or before September 1st, 2023, and report it to the depositories. And similarly, in case of issuers who are proposing to list these securities, are required to obtain it before allotment of ISIN and report it to the depositories. Next, we look at the amendment relating to the Settlement Guarantee Fund. So, SEBI at its board meeting held on September 29, 2020, permitted the setting up of a limited purpose clearing corporation, that is an LPCC. Along with this, it also approved setting up of a settlement fund and contribution of a designated amount to build this fund under the LPCC. Now, SEBI wide circular dated April 13, 2023 has recognized AMC Repo Clearing Corporation, that is ARCL, as the LPCC. ARCL has laid down the criteria for certain issuers to be identified as eligible issuers. These eligible issuers will be required to contribute 0.5 basis points of their issuance value of NCDs, whether issued on a public issue basis or a private placement basis, to the LPCC. Certain instruments are excluded from certain issuances have been excluded, like issuance of tier 1, tier 2 bonds, PDIs, floating rate bonds, market link bonds, convertible bonds, whether optional or compulsory. This amount would be placed in a separate escrow account prior to allotment, and it would be transferred to the bank account of the LPCC within 1 working day of receipt of funds. Stock exchanges are required to disclose this information on their website. Now, what is the criteria to be identified as an eligible issuer? This includes having a positive net worth as per your latest audited financial statements, being a profit-making entity, having your equity listed on 1 or more stock exchanges, having long-term debt rating of AAA, AA plus, AA, and AA minus. Other amendments under the NCS regulations. So there were amendments relating to green debt securities, which we would be discussing in the further slides. The next amendment related to serving of notice in case of early redemption, that is recall or redemption prior to maturity. So in this case, issuers are obligated to send a notice to eligible holders. Now this notice can be sent in the form of a soft copy via registered email IDs with the listed entity or the depository. And where email IDs are not available, they can send the notice in the form of hard copy. Also, the requirement to publish this notice in the newspaper has been done away with. Next, the timeline of offer period for public issue has been revised. So the offer is to be kept open for a minimum period of 3 working days up to a maximum of 10 working days. This has been aligned with the SEBI ICDR regulations. Thirdly, regulatory fees have been prescribed for issuance of PDIs and perpetual non-convertible preference shares. These fees would be collected by the designated stock exchanges as per Schedule 6. Let us look at the changes in the regulatory framework governing green debt securities. So firstly, the definition of green debt securities has been broadened. So this now includes new categories which is in line with the ICMA green bond principles. It also includes transition bonds aligned with India's nationally determined contributions. Certain colored bonds like blue bonds, yellow bonds have been identified for easier identification of the end use of these bonds and also for attracting more number of investors. Amendments have been made to Chapter 9 of the Master Circular, NCS Master Circular, which provides for initial and continuous disclosures to be made by issuers of green debt securities. So, pursuant to these changes, it is now required to mandatorily appoint an independent third-party reviewer. It will promote transparency of information, and it would also attract impact reporting on an annual basis. Thirdly, Chapter 9A has been inserted in the NCS Master Circular. This chapter provides for do's and don'ts with respect to greenwashing. This will basically help identify any use of proceeds for non-authorized purposes. And investors would have the option of early redemption in such cases. It would also prohibit misleading labels, cherry picking of data, and making untrue claims. Now let us look at the changes under the SEBI listing regulations. Firstly, the provision with respect to mandatory listing of NCDs. So, pursuant to this amendment, issuers having outstanding listed debt as on December 31st, 2023 are now required to mandatorily list all future issuances post December 31st, 2023. And in case of unlisted issuances prior to December 31st, 2023, these securities can also be optionally listed. In case of issuers which do not have listed debt as on December 31st, 2023, uh, they and in case such an issuer lists its issuance at any point of time post 31st December 2023, firstly, it would be mandatorily required to list all subsequent issuances. Secondly, all the unlisted issuances during the period 1st Jan 2024 and the first listed issuance that it comes up with, all these unlisted issuances will be required to be listed. Again, in a similar manner, it would have the option of listing unlisted issuances issued prior to December 31st, 2023. There are certain issuances which have been exempted from the requirement of mandatory listing, which include bonds issued under Section 54 EC of the Income Tax Act, pursuant to an agreement between listed entity and multilateral institutions, pursuant to any order of court or tribunal, or issuances pursuant to any regulatory requirement specified by a specific regulator. Let us look at the voluntary delisting framework that was brought in by SEBI during the year. So this voluntary delisting framework would be applicable for delisting of NCDs or NCRPS. There are certain exclusions to the framework. So public issuances cannot be delisted. Issuances which have more than 200 non-QIB holders also cannot be delisted. Delisting which is happening pursuant to any penalty or action initiated against the listed entity would be exempt from following of this framework. And delisting which is happening pursuant to redemption or pursuant to a resolution plan under IBC would also not require compliance under this framework. Now, there are certain obligations that are placed on the issuer under this framework. For example, obtaining consent of all the NCD or NCRPS holders, as the case may be, within a prescribed timeline. Issuer is also required to make disclosure at every stage till the delisting process is completed. And there is certain prescribed additional information that the issuer would have to display on its website as well as on the stock exchange website. This process, which we have detailed in the form of a flowchart in the next slide, would be deemed to have been failed in case the issuer does not receive the in-principle approval from the stock exchange, or it is not able to obtain the approval of all NCD or NCRPS holders, or in case of non-receipt of NOC from the DT. Now we look at the framework for dealing with unclaimed amounts. So any entity which has its non-convertible securities listed and there is any amount relating to interest or dividend or redemption which has not been claimed for a period of 30 days from the due date, the SEBI has prescribed a format, a framework for claiming of such amount. Now, the timelines under the circular are as follows. So, in case of unclaimed amount which is lying in the escrow account for less than 7 years, as on February 29, 2024, interest has to be computed on this amount from March 1st, 2024 onwards in the manner specified in Annexure A to this circular. Uh, on the other hand, if there is any amount lying in the escrow account for more than 7 years, as on February 29, 2024, this amount is required to be transferred to the IPEF in compliance with the provisions of Annexure B to the circular. There are certain actionables under the framework, like dissemination of the provisions of the circular on the website of the company. Secondly, designating a director or a CFO or a CS or a CEO as the nodal officer who will act as a POC for investors, SEBI, stock exchanges, and depositories. Any change in this nodal officer, uh, in case there is any change in this nodal officer, then a new person would be required to be designated as a nodal officer within 15 days of such change. The entity would also have to provide a search facility on its website, which would enable the investors to verify if there is any unclaimed amount due to them. Entities are also required to formulate a policy which would detail the process to be followed by investors for claiming such unclaimed amounts. Lastly, we look at the requirement of the framework of high value debt listed entities. So, SEBI introduced this concept of a high value debt listed entity, basically an entity which has listed non convertible debt securities with an outstanding principal value of 500 crore or more as on March 31st, 2021. These entities are required to comply with certain corporate governance provisions, which we'll be seeing in the next slides. This requirement was applicable on a comply or explain basis till March 31st, 2024. So from April 1st, 2024 onwards, it will be applicable on a mandatory basis. In case of entities which subsequently become HVDLEs, a time period of 6 months would be available from the date when the listed entity becomes an HVDLE to comply with these provisions. Now, provisions of Chapter 4 of SEBI listing regulations, which deal with corporate governance related provisions. For example, provisions relating to board composition, appointment of independent directors, provisions relating to board meetings, constitution of certain committees and their composition, meetings, etc., framing of policies and codes, obligations with respect to senior management directors, all of these provisions become applicable once an entity is identified as an HVDLE. Since these provisions become applicable on a mandatory basis from April 1st, 2024, in case of non-compliance thereafter, with respect to any of these provisions, penalty as per the SEBI SOP would apply on these entities. That's it from my side. I hope this was an insightful video. For further reading, you may kindly refer to the links in the description box.